As an investor, whether institutional, retail or financial advisor, you have certain tools at your disposal in your capital allocation decision. One of these tools is the ability to allocate capital to a hedge fund like Peregrine Capital. And in turn, hedge funds like Peregrine Capital have a certain toolbox with a variety of different tools that we use in order to generate truly differentiated returns for our investors. And today, I would like to give you a better insight into these tools and also tell you more about how we as Peregrine Capital use these tools in our own hands. Now, as a starting point, it is important to remember that the tools that a hedge fund have is different to those used by other funds like unit trusts or long-only fund managers as they are referred to. The tools that a hedge fund have allows us to generate truly unique and differentiated returns. So what are these tools? Firstly, the ability to do short selling. So as a hedge fund, unlike unit trusts or long-only fund managers, we can actually profit and benefit from a decline in share prices. For example, if we have a fundamental view that a certain company would underperform or would perform badly, we can go and sell or short these shares and benefit from a decline in the share price. For example, if a share price is trading at 100 Rand per share and we think this company is fundamentally flawed or in for a tough period and the share price will decline, we can go into the market and borrow these shares from another fund manager and sell or short them in the market. And if we are right and the share price declines to say 90 Rand per share, we can go into the market and buy these shares back. Therefore, having profited from the move or the 10 Rand move in the share price and also protecting our investors against the drawdown. As a long-only fund manager, you can only buy shares. You cannot short, and therefore you cannot profit from a decline in share prices or protect your investors or shield your investors from a decline in share prices. Another use for the same tool, referring to short selling, is the ability to do pair trades. Now, a pair trade is where we would buy the shares of one company and sell or short the shares of another company against this. And the reason you would do this is to take advantage of the relative difference in performance of two different companies without having to take an outright view on whether the overall market is going up or going down. And more often than not, pair trades are done between two companies within the same sector because more often than not, companies in the same sector are influenced by the same external factors. And we all know this. Some companies are inherently just more profitable and have better management teams than other companies. And as such, you want to buy these companies and sell or short the companies in the same sector that perform worse, and therefore benefit from the relative difference in performance. Another tool that we as hedge funds have is the ability to use derivatives in the form of options. Now, think of this similar to taking out insurance, where you would pay a small premium and in turn you get to protect a large part of your portfolio against a potential catastrophic event. If events don't turn out as bad as you anticipated, all that you stand to lose is the premium that you paid. Think of this similar to your house insurance. If your house did not burn down in a given month, you won't lose sleep at the end of the month of the premium that you paid during the month. You have the comfort in knowing that you protected your house against a potential catastrophic event. Hedge funds have this tool at our disposal, and at Peregrine Capital, we have been using this tool successfully for more than 25 years. And the most prominent example of this is recently in 2020, during the COVID pandemic, we bought insurance in the form of put options on the S&P 500 in the early days of the COVID pandemic as it started to evolve. And as the market crashed and declined, these insurance contracts increased tremendously in value, and it allowed us to redeploy capital in attractively valued opportunities. Now, as a long-only fund or a unit trust, you don't have the ability to use this tool in the form of derivatives and option trades to protect the portfolio or to profit from a specific event. The last tool I want to talk about is the ability to be unconstrained in the way that we operate. Now, at Peregrine Capital, our sole and only focus is to generate wealth for our clients. And the ability to be unconstrained in the way that we operate is a great tool that helps us to achieve this. Meaning that we can invest in any geography, across any asset class, using any instrument type, as long as we generate wealth for our clients. Like a unit trust or a long-only fund manager, for example, they normally track a specific benchmark or an index, and because of this, they have to own the shares that are present in the index or benchmark, even though they might not like some of these companies. On the other hand, we as a hedge fund, if we fundamentally don't like a company and the prospects that this company face, we don't have to own a share, and in fact, we can bet against this company if we think that this company will perform badly through the means of short selling and pair trading, and therefore not only protect our investors, but but also profit from a decline in share prices. Lastly, it is important to remember that hedge funds like Peregrine Capital have a truly unique and differentiated toolbox with a variety of different tools such as short selling, pair trading, the use of derivatives, and the ability to be unconstrained in the way that we operate. At Peregrine Capital, we've been using these tools for more than 25 years, and as such, these tools are comfortable in our hands. We are confident that we can continue to generate wealth for our clients in a way that is differentiated, uncorrelated, with less volatility.